Hi, I'm Steve LaFrance and Happy New Year. December turned into a choppy month for the markets, yet 2024 finished with impressive gains. So let's look at the year-end summary. In short, markets had a mixed performance in Q4. October started slow, but a broad rally in November triggered by the presidential election outcome pushed the S&P close to its all-time high. However, the rally faded towards the end of the year, and in the credit markets, the Fed cut rates by 0.5%, leading to a sharp rise in Treasury yields. This shift reflects the market's expectation of fewer rate cuts in 2025. Looking back at the 2024 stock market rally, the S&P had a remarkable year, setting over 55 new all-time highs. Large-cap tech stocks, particularly the Magnificent Seven, Microsoft, Apple, Alphabet, Meta, Amazon, Nvidia, and Tesla, drove much of these gains. As I've mentioned before, I'm not making a recommendation, but these 7 companies, which now account for more than 33% of the S&P 500, returned over 60%, helping the S&P complete the year with a 24.8% return and marking the first time since the late 1990s that the index had posted such strong back-to-back gains of over 20%. There was a significant gap between large-cap and small-cap stocks. While the Mag 7 returned over 60% and the broader S&P returned approximately 23%, an equal weighted index of the S&P returned just 11%, and mid to small cap companies returned just between 10 to 12%. In total, only 26% of all stocks outperformed the S&P, significantly below the average of 49% since 2000, which highlights the dominance of the largest companies in driving the market's performance. The economy has shown remarkable resilience, growing at an above-average trend rate. In Q3, the U.S. economy grew at 3.1%, with 3 of the past 4 quarters posting growth above 3%. Consumer spending remained strong, supported by high stock prices, rising home values, and solid wage growth. We also observed a surge in manufacturing-related construction, driven by new infrastructure and green energy spending since 2022. The Fed cut rates by 0.25% in both November and December for a total of 0.5%, which disappointed the market by signaling fewer rate cuts in 2025 due to the economy's strength and inflation remaining in the mid-2% range. This led to a sharp rise in 10-year Treasury yields, reflecting the market's reevaluation of rate cut expectations this year. Looking ahead, the market remains optimistic about the artificial intelligence industry's growth potential and the new administration's pro-growth policies. However, the rally has made broad market indices like the S&P 500 more concentrated and more expensive. The question on many minds is whether the momentum can continue in 2025. The S&P currently trades at nearly 22 times its next 12-month earnings estimate, a level not seen outside of periods like the late 1990s tech boom and the recent post-COVID recovery, when interest rates were near zero. Investors have shown a willingness to pay higher multiples, but with valuations now at extremes, earnings growth will likely play an important role in determining the stock market's path in 2025. The current bull market, which started in October 2022, is now in its 3rd year and has performed in line with historical norms. But returns often moderate as bull markets mature. This suggests that the market's focus could shift to fundamentals and earnings as the next catalyst to push markets higher. 2025 is shaping up to be a year where companies will need to deliver on investors' expectations to justify these higher valuations. That's all for now. Stay the course, take care of yourselves, and thanks for your trust and confidence.